Hey everyone, and a huge welcome to all you CA Enter students out there. Today, we're jumping straight into one of the most practical standards that ICAI loves to test, AS4. Look, this isn't just about theory, it's about grabbing those marks that can make all the difference. So, let's get right into it.
Okay, let's kick things off with a classic IKI trap. Just imagine this. It's April 10th. You're trying to finalize the accounts for the year that just closed on March 31st. All of a sudden, you get a call. Your biggest debtor, the one who owes you a ton of money, has just gone bankrupt. What do? I mean, seriously, do you go back and change those March 31st numbers, or do you just leave them be?
Well, how you answer that one question is pretty much the entire game of AS4. You get it right, you score the marks. You get it wrong, you've walked right into the trap the examiner set for you. So today, our mission is simple. We are going to break down the rules of AS4 so you can face any problem like this with total, unshakable confidence.
Now, before we can even begin to talk about what happens after March 31st, we've got to get on the same page about how accounting deals with uncertainty. And that brings us to our very first big idea, contingencies.
So what on earth is a contingency? Well, think of it like this. It's a financial what-if. It's a potential gain or a potential loss that's just kind of hanging in the air. We don't know the final outcome yet because it all hinges on something happening in the future. A classic example? A lawsuit. You've been sued. Are you going to win? Are you going to lose? Right now, it's a big question mark. That's a contingency.
Okay, this is important. How we handle a potential loss is totally different from how we handle a potential gain. And it all comes down to one of the most fundamental ideas in accounting, the prudence principle. For contingent losses, if it seems likely that we're going to have to pay up, prudence says, be a pessimist. You need to provide for that loss right now. But for contingent gains, prudence says, hold your horses. Be super cautious. You do not recognize a potential gain. Why? Simple. We never ever want to book profits that we haven't actually earned yet. This difference is a huge deal, and it gets tested all the time.
So, let's say we've decided a loss is probable. What's next? We have to figure out how much. This is where management's best judgment comes in. Maybe they'll even get reports from lawyers or other experts to help out. But listen up, because this is where marks are lost. What if you just can't come up with a reliable number? If you cannot estimate the amount, you cannot create a provision. I repeat, you can't. Instead, you have to disclose the whole situation in the notes to accounts. So just writing provide for the loss in an exam isn't enough. You have to consider if a reliable estimate is even possible.
And those potential gains, the rule is just ignore them. Seriously, we don't book them, we don't put them in the notes, we just pretend they don't exist. The only time you recognize a gain is when its receipt is, and this is the key phrase, virtually certain. Think about it. If something is virtually certain, it's not really a what-if anymore, is it? It's pretty much a done deal. It's become a real asset you have a right to.
All right, so we've got a handle on uncertainty. Now let's get to the second, and arguably the most exciting part of this standard, the timeline. This is the very heart of AS4. This is where the real exam game is played. What do we do with things that happen after the year has ended?
Okay, look at this timeline. This is your single most important picture for understanding AS4. You've got your balance sheet date, March 31st. Then, way down the road, you have the date the board of directors signs off on the financials. Let's say September 4th. That period in between those two dates, that is our focus area. Anything that happens in that window is what we call an events occurring after the balance sheet date.
So, to be super clear, the standard defines these as any significant events, could be good, could be bad, that pop up between the balance sheet date and the date the financial statements are formally approved. For a company, that's the board of directors. That approval date is the hard stop, the final cutoff. Anything that happens after that date, that's a problem for the next financial year.
Now, every event in this special period falls into one of two buckets, and I want you to think of yourself as a financial detective. The first bucket is adjusting events. This is like getting a new clue for a case that was already open on March 31st. The situation was there, we just found out more about it now. For these, you got to go back and adjust the numbers. The second bucket is non-adjusting events. This is like a brand new case that started after March 31st. For these, you don't touch the numbers, but you might need to tell people about it in a disclosure.
This difference, adjusting versus non-adjusting, is everything. It is the absolute core of this entire topic. I can almost guarantee you any exam question you get on AS4 will test your ability to tell them apart. So let's nail down exactly how you make that call.
Here it is. This is the mental flow chart you need to run through for every single problem. Step 1, an event happens in that critical time window. Step 2, and this is the million-dollar question, does this event give you new info about a condition that already existed on March 31st? If the answer is yes, you go to Step 3. It's an adjusting event. You have to change the numbers. If the answer is no, you follow the path to Step 4. It's non-adjusting. You don't change the figures. But, and this is important, don't forget Step 5. If that non-adjusting event is a big deal, you still have to disclose it.
Okay, we've got the main rules down. Now let's zoom in on a couple of special cases. Trust me, these are favorite areas for ICAI to check if you're really paying attention.
Right. Two big ones here. First, proposed dividends. If a dividend is declared after March 31st, it is not a liability for that year. Why? Because on March 31st, the company had no legal obligation to pay it. You just disclose it in the notes. Second, and this is a huge one, is the going concern assumption. What if something catastrophic happens after the year end, like your only factory burns down in April? Now that's a non-adjusting event, so you don't book the loss. But the event is so massive, it raises a fundamental question. Can the business even survive? In that case, the entire way you prepare the accounts might have to change.
Here's a super practical exam tip for you. A company gets a check in April, but the date on the check is March 31st. Can they show it as cash on their March 31st balance sheet? The answer is a hard no. And the reason is all about control. On March 31st, they didn't have the check. They couldn't do anything with it. You can only record an asset when you control it. So receiving it in April is a non-adjusting event. It's a subtle point, but a very important one.
All right, enough theory. The best way to really get this stuff is to see it in action. So let's apply everything we've learned to some classic exam-style problems and figure out how to write that perfect mark-scoring answer.
First one up, a company had 5 lakhs in cash stolen back in January, but they only figured it out in May, which is after the balance sheet date, but before the accounts got approved. What's the right move here?
Okay, let's run it through our flowchart. The key question is, when did the condition, the actual theft, happen? It happened in January. That's before March 31st. Discovering it in May is just new evidence about that old event. So this is a perfect example of an adjusting event. The company absolutely has to go back and adjust its financial statements for the year ended March 31st to show that 5 lakh loss.
Okay, next, let's look at two scenarios side by side. In the first case, a massive earthquake in May completely destroys a warehouse. In the second, you had already filed a lawsuit against a debtor by March 31st, and in April, your lawyer calls and says, yeah, you're not getting that money. Let's break them both down.
This slide is gold because it shows you the core difference perfectly. The earthquake, that's a brand new condition. It arose after the balance sheet date, so it's non-adjusting. You don't book the loss, but you definitely disclose it. Now, the bad debt, think about it. The condition, the fact that the debt was dodgy, already existed on March 31st. How do we know? Because we'd already sued them. The lawyer's call in April is just confirmation. That's a textbook adjusting event. You have to make a full provision for that bad debt in your March 31st books. Nailing this distinction is how you get all the marks on this topic.
Okay, time for a rapid-fire round to really test your skills. Let's hit 3 quick scenarios. Case A, a company makes a big investment in April. Case B, a huge cost is found on September 1st after the accounts were already approved on August 20th. And Case C, a debtor goes bust in April because of a big loss they took way back in February. Let's tackle them. Okay, for the investment in April, that's a new decision, a new event after March 31st. Easy, it's not adjusting. Now the extra cost, look at the dates. This is a classic ICAI twist. It was discovered after the accounts were approved, so it doesn't even fall under AS4's definition. It's an event for the next financial year. Finally, the bankrupt debtor. This takes us right back to our first problem. The reason for the bankruptcy, that heavy loss, happened in February before March 31st. The bankruptcy in April is just the final domino to fall. It confirms a condition that already existed, so it is absolutely an adjusting event. You have to provide for that loss.